Well, retail sales on both sides of the border have been rising despite higher gasoline prices. But is that strength playing through to consumer stocks? Joining us now to discuss is Linda Otamendi, Associate for Portfolio Research with TD Asset Management. Linda, welcome back to the show.
Thanks so much. Hard to believe it's almost been half a year since I was last here.
Exactly, and a lot has happened since you were last on the show about 6 months ago. How has that impacted the consumer backdrop?
Yeah, so on top of everything thrown at consumers over the past 2 years, from tariffs, inflation, and higher rates, we now saw a geopolitical shock as the cherry on top, which created a lot of volatility around oil prices and consumer stocks. Yet despite all of these headwinds, consumers do remain quite resilient, with spending continuing to surprise to the upside. And if we think about what's been driving that, the last time I was here, I used the analogy of a treadmill, where inflation was the speed and rates were the incline. And at the time, both had tapered down. And on top of that, consumers were about to get extra juice from fiscal stimulus, where elevated tax refunds would come on the back of the One Big Beautiful Bill Act. So if you put that together with the healthy employment that we've seen and strong equity markets, that's created quite a conducive backdrop for consumers in the first half of the year. And as we look into the second half, I don't think much changes now that oil's back at $70 a barrel. And as long as wages and equity gains remain relatively stable, I think that supports more healthy consumer spending in the second half of the year again.
Okay, so let's break down that spending more. And are you seeing the strength more broad-based, or is it more locally focused in certain pockets of the market?
Yeah, so I did bring this chart showing monthly credit card spending, where you can see by the dark green line that has continued to accelerate throughout the year. And even if you strip out gas-related spending, which is the purple bars there, all other categories still remain in positive territory. And it is primarily the high-income households that continue driving this, where the top 10% are contributing around 40% of that spend. And they've been the ones to benefit from gas prices only representing around 2% of their wallet share versus close to 5% for the lower income households, and also benefiting from the strong equity markets that we've seen. And so with that additional disposable income they've had, they're increasingly choosing to prioritize experiences over goods. And you can see by the light blue and the light green bars there that travel and restaurant spending continues to tick higher. And so travel has been in the category of particular strength, especially as we started to lapse on the weaker US travel that we saw post-Liberation Day last year, and also seeing a nice boost from World Cup this summer. Also, one more point on this chart is that helps frame up that outlook that I was talking about earlier, because you can see that gas spending has rolled over since May. And so if that continues its downward trend like it has, that's pretty supportive of a risk-on sentiment within consumer. But even at current levels, the high income can likely continue to look past that, because as long as people are employed and seeing their accounts tick up, they will continue to spend.
Okay, so let's talk about wages and employment. And how are they holding up right now as you see it? And more importantly, is AI having an impact on how those employers manage their workforce?
Yeah, sure. So unemployment in Canada and the US does remain slightly elevated relative to their long-term trend, but it has started ticking down month over month. And because even though we've seen some cooling on the labor demand side, we've actually seen slightly more on the supply side, especially as immigration has slowed. So overall, it seems like companies remain in this low hire, low fire environment, as they are probably trying to navigate everything unfolding from a geopolitical and trade point of view, and are also likely in the midst of building out their AI strategies and reorganizing internal functions accordingly. So as it relates to AI, more specifically, it actually appears to be somewhat labor augmenting thus far, where we've seen a slight uptick in temporary hiring related to data center infrastructure buildouts. And on the white-collar job side, seeing little evidence of broad-based displacements. And so overall, it seems like companies are viewing AI as a productivity enhancer and choosing to do more output with the same amount of people rather than the same output with less. So we'll see how that all continues. There is definitely this bearish narrative out there around AI's ability to displace labor. But even if we think back to previous innovation cycles like the Industrial Revolution or internet boom, there were similar fears at first, but over time we actually saw it lead to accelerated GDP growth, higher employee productivity, and net job creation. So if we think back to the internet in the early 2000s, I'm sure no one had gig workers and social media influencers on their bingo cards as potential careers, but here we are. So
Things change.
Things for sure change. So it'll be interesting to see how this evolves and whether it actually does end up leading to higher real wages and purchasing power over time.
And as this evolves, how are you monitoring these developments, and how does that influence your outlook for the consumer sector?
So I think about my outlook for consumer, there's two pillars that I'm actively monitoring. The first would be more on the cyclical side of things, and namely how inflation and monetary policy shake out in the near term. So if oil does remain at $70 a barrel, that's likely enough to keep inflation in check and support a more benign policy going forward. The second would be more structural as it relates to long-term around AI and whether it enhances or displaces the labor market. So I think the key question here isn't whether AI takes over existing jobs, but probably better questions to monitor will be, does this technology actually generate incremental economic demand that require additional inputs from labor and capital? Does it actually enhance employee productivity, which can actually lead to higher wages over time? And third, how quickly is it actually creating new jobs that can absorb any displacements? So overall, any positive developments across these two pillars would make me more constructive in a broadening out in consumer spending and stocks, especially given that ownership is currently around its 5-year lows in the sector.
All right, so with that backdrop, what should investors be looking for if they're interested in this sector?
Yeah, so as I alluded to, the sector has been out of favor for some time, but that has created some opportunities in stock picking within the space, especially as some stocks are trading below their intrinsic value. And so when I think about stock selecting, I usually use a 3-part framework. The first, looking at the industry itself. Is this an attractive industry that grows above GDP and is supported by some durable secular tailwinds like experiences, convenience, and digitalization? The second would be looking at the company and whether it has a proven track record of gaining market share through some combination of value, innovation, brand messaging, and superior execution. And then finally, the third, looking at the stock and evaluating whether the timing is supported by valuation, some positive catalysts on the horizon, or technical indicators. And I find that when all three align, that's typically when investors can expect the best risk reward out of consumer stocks.